Hello everyone, this is Srimathi. I work as financial planner with iThought. It gives me immense pleasure to share this afternoon with you all. Today's discussion is going to be about risk management. We are going to see how to manage risks that we face in our everyday life. Before I begin to explain, let me introduce a person to you all. Have you heard of this person? He's the most famous skier in the world today. His name is Chris Davenport. He's a two-time world champion skier and one of the most well-known skiers in the world today. He's the first person to ski all 54 of 14,000 foot peaks in Colorado in less than a year. It's one of the biggest achievements and no one has dared to do this till now. But why am I talking about this person today? Because his life revolves around risk every day, right? His career itself is a risk. Skiing is a risky activity. He says that risk is any activity or action that has the potential to go wrong. Risk can be of two types. It can be both unknown risk and known risk. What is known risk? Known risk is something like investing in a business, knowing that the business is risky, still you choose to invest in the business because it's thrilling for you. Or taking an adventurous sport activity. You know that it's risky, but you still choose to do that activity because some people like to take risk. Whereas there is another extreme of risk which are unknown risk. What are unknown risks? Sometimes you have the risk of meeting with an accident or your car might break down, or even natural calamities like volcanoes or earthquakes are unknown risks. How do we manage such risks? Are we ready to face these risks in our life? Let's use some approach to manage risk in our everyday life. Let's see what Chris uses in his life and try to implement it in our everyday life. He uses something known as MEAT, meat approach. It's not the meat that we eat, it's mitigate, eliminate, accept and transfer the risk. How does Chris mitigate the risk? If he sees that there's going to be an avalanche on the mountain, he would call up the authorities and ask them to throw bombs on the mountain so that the track becomes clearer, so that the risk is mitigated for him. He's tweaking the situation and mitigating the risk. How does he eliminate and accept the risk? If he sees that the weather is bad today and it's not possible for him to ski on the mountain, he accepts the risk and he mitigates the risk. That is, he doesn't do the activity at all. The last one is transferring the risk. How does Chris transfer his risk? It's like learning from other person's lesson. Sometimes when he's skiing on a mountain, if Chris sees that the cliff is steep and he lets the other person go before him and see how deep the landing is or how sharp the landing is, he let the other person go before him and learns from that. So this is how he transfers the risk. It's something like in a swimming pool, you let the other person go before you and see how cold the water is, then you take the dive. This is how he transfers the risk. Now that we know what this approach is, let's try to implement this approach in our everyday life. I'll give you few scenarios and let's see how we can implement this approach. First scenario, you're walking on the road and your phone falls down and the screen shatters, or you can even imagine that there is a phone snatching that could happen. How can you manage the risk in this situation? While using the MEAT approach, how to mitigate the risk? By investing in a screen guard. If you had a screen guard, probably your phone wouldn't have shattered. How do you eliminate and accept the risk? You accept that using the phone on the road is not a good idea and you completely eliminate the activity. You don't use the phone on the road. How do you transfer the risk? You could have had an insurance policy for your phone. These days phones are expensive. So you could have had an insurance policy by which you transfer the risk to the insurance provider. This is a very common, or these kind of activities can happen in your everyday life. From a financial planning perspective, we feel that it's important to have a contingency reserve. To face emergency situations in your life, if you're an individual, it can be 3 to 6 months of your expenses. If you're a business person, it can vary depending on the nature of your business and other activities involved in the business or the payables that are there in your business. Whereas we recommend that the contingency reserve should be part of these 4 combinations. It can be cash, it can be kept as fixed deposits, can be kept as liquid funds, or it can even be in your savings bank account, so that whenever in case of emergency you go withdraw the money from your ATM and use it in case of emergency fund. Simply put, we say that contingency reserve is nothing but your rainy day fund. This is the first important risk management tool that you need to adopt. Let me show you 3 more scenarios and think about what could we do to manage risk in these situations. Your friend falls sick and he goes to the doctor and he is diagnosed with dengue, and the doctor says he needs to get admitted. Second scenario is your neighbor passes away, he is left with dependent wife, his kid, dependent parents. There's clearly a loss in the source of income here. If you were in Chennai in 2015, you obviously know that Chennai was underwater. We faced the floods in the year 2015 and there was loss of assets and loss of lives during that flood. Given these 3 scenarios, what's common in these 3 scenarios? These are unknown risks. People didn't see this coming, but still this happened to them, right? What do we do to manage such risk? Answer is insurance. You have both life insurance and general insurance. Under general insurance, you have health insurance, vehicle insurance, motor insurance, and various other insurances. But for today's discussion, let's concentrate on life insurance and health insurance. Why do we need life insurance? Imagine you're the breadwinner of the family, and if something were to happen to you, there's going to be a clear loss in the source of income. And to replace that income, you need money. Your family needs money, right? That's why you need life insurance, and you need to understand that life insurance is a pure risk tool. Why am I saying this? Imagine that you're invested in a traditional life insurance policy, say an endowment policy or a ULIP for 20 to 25 lakhs. If something were to happen to you, will your family be able to sustain with this income? Say they have around 25 to 30 years to lead ahead. Will this 25 lakhs be enough for them? No, right? So typically your life insurance has to be in crores, and it depends on your income and various financial goals of your family. And you should understand that insurance and investment should be separated, and insurance is a pure risk product. It's for your dependents and not for you. When you choose a life insurance product, it's important to understand this crucial point, that you don't need life insurance but your family needs life insurance. And why am I emphasizing on term insurance? It's because traditional policies could cost you 10 times more than the term insurance policies. Moving on to health insurance. Why do we need health insurance? Let me throw a fact to you. Today in India, 1/3 of the population are made of younger generation. That is, 1/3 of Indian population is under 35 years of age. While on the other hand, you see that in the last 10 years, hospitalization costs have gone up by 175%. The 1/3 of Indian population, only 3% of them are actually insured. On one hand, you have raising hospitalization costs. On the other hand, you have very low penetration of health insurance. This is precisely why we need insurance, to cope with medical emergencies and to cope with medical inflation. Beyond health insurance, we should consider taking critical illness insurance. Imagine if something were to happen to the breadwinner of the family. If he or she is detected with cancer or heart disease, there's going to be a clear loss in the source of income, while you have to concentrate on treating that disease as well, right? If you have a critical illness insurance, you can concentrate on treating the disease, be positive towards curing the disease. On the other hand, you need not worry about the financial distress that could happen because of this event. It's important to consider taking critical illness insurance along with health insurance. There are few checklists to consider before taking an insurance policy, be it life insurance or health insurance. First one is to see how much insurance do you actually need. You need to understand how much insurance your family needs, what are the financial goals of your family, your income, your expenses. There are various factors involved in deciding how much insurance you actually need. The second one is to see if your policy is actually cost effective. You need to do a cost benefit analysis. Like I mentioned, the traditional policies are going to be 10 times more expensive than your term insurance policy. You need to do analysis and check if the money you're paying towards the premium is actually worth. And the third one is to see the inclusions and exclusions involved in your policy. Read the policy document carefully. If you're taking a health insurance, check what hospitals are covered under the insurance, what diseases are covered under your insurance. Important to see what are the inclusions and exclusions of your policy, right? You need to understand that risk management is going to be a very holistic approach and there are various factors involved in managing your risk. Just remember the MEAT approach that we spoke about. Try to mitigate your risk, try to eliminate or accept the risk. If not, try to transfer your risk. I am going to end today's discussion with a quote by Benjamin Disraeli, who was a former British Prime Minister. He says, "I am prepared for the worst but hope for the best." Thank you.